Hello, my name is Lindsay. Thank you for joining today's Family Office Network's webinar series featuring the IQEQ group. Before we get started, I would like to briefly introduce our speakers today. Boss Horston is currently Director of Sales and Business Development. Boss is a TEP member of STEP and has 25 years of experience in estate planning and corporate and trust services. He has prior experience in General Manager of Operations in respectively Cayman, BVI, for a large fiduciary services group. For the past 20 years, his commercial focus has been the Americans with a specific interest in wealth planning for the Latin American high net worth individuals and families. He holds a law degree of Hermes University of the Rotterdam, the Netherlands. Hugh Stacy is also joining us, Executive Director, Investor Solutions. Hugh joined IQEQ as the Executive Director of Investor Solutions, which is a division dedicated to the servicing institutional and private investors providing back office services coupled with an end-to-end portfolio monitoring solution. IQEQ Investor Solutions aims to meet the needs of investment managers and their investors, delivering real-time data reporting, data analysis, and their investment portfolio. At the end of today's presentation, we will have time for Q&A. Please use your questions chat option on your screen to send over any questions you have so we can answer them accordingly. And with that said, gentlemen, I will let you take it from here.
Thanks, Lindsay.
Thank you.
Hi, everyone. I'm going to take my camera off just so people can look at the slides. And hopefully, if anyone's got any questions, they can answer at the end. So today's webinar is tech-enabled portfolio monitoring strategies for investors and family offices. So if we start with what is the impact of technology for wealthy families and their investment. Back in the summer, IQEQ, in collaboration with Barton Consulting and WealthX, published a paper called The Great Wealth Transfer. What this showed was there's huge changes occurring with the ultra high net worth and family office space. And a lot of that was due down to various factors such as social economic factors, globalization of wealth. So for example, many family members now live abroad, not physically in the same country as where they made their wealth. And actually in some instances, family members may speak different languages from family office employees or even from the wider family. There's also been shifts in investment focus. So moving away from the traditional asset classes and more into alternatives like venture capital, hedge funds, private equity, real estate, and often more into direct investments. There's also been an increase in sophistication of the family office. So, for example, many family offices may be quite small, but they have aspirations to grow into a multifamily office or even a asset management firm. So to have that aspiration, you really have to be able to utilize technology, and technology has become a real enabler for people to cope and manage on the above factors. So things like simplifying sort of repetitive processes, all of these things can have a real sort of positive impact if you use technology. But there is a caveat to that, and I think a lot of the people around on the survey that we did in the summer were mentioning that technology had to be simple. Simplicity was the key. So what types of technology are more relevant for family offices? So I think there's been an absolute burst of technology on the scene for family offices and private investors. And there's a whole multitude of different ways you can use technology, but I've just listed a few down here. So for example, communications. What we're doing today on this webinar, we're using technology, so Zoom, Teams, etc. And again, there's a whole raft of different providers out there. Then there's compliance. So for example, anti-money laundering, regulatory compliance, reporting and filing, and then obviously there's the training of personnel and staff in compliance. Again, there's a whole raft of technology. For example, Lawson Collins Max Comply. All of what I've just mentioned pretty much is in one place online. There's things such as deal sourcing. So IQEQ recently launched a platform called Cross Deal, where family offices and private investors can go on to the online platform and look at different deals which may be out there. And again, so just really utilising, especially now when travel is becoming more and more difficult and face-to-face meetings are harder to come by, the utilisation of technology has become really important. And that's also moves on to the actual, transaction due diligence as well. So all of the front end part of doing deals it can utilise technology. And then more on the sort of back end side of things. So, for example, making sure that you don't come foul of cybersecurity or cybercrime, you have to implement and utilise technology to combat that. And then when people are in different geographies, things like training staff, again, utilising technology online. And then the last one, the data collation analytics. This is really important for the sort of front end portfolio monitoring aspects. So, being able to look at your portfolio, slice and dice that portfolio, and then being able to make some informed decisions on whether you invest more in one asset class or more into a company, or whether you want to take stocks out, etc., to balance it all out. All of that can be done through portfolio monitoring. And that's what I'll concentrate further on in the slides. But really, I think what's really important before you decide to implement any of these technologies, you have to identify what is actually going to be useful to you, your particular family office, or your particular role within that family office. So it's very important to get stakeholder and user engagement right at the beginning of the process before you start going for tender. And I think a lot of groups fall foul of this, in that people sort of think, right, we need to get technology, we need to improve that process, and we'll let technology be the way forward and how we do that. That doesn't always in the end mean success. And then one of the other things about that is that people don't realize who is the end user, who's going to be using that. And therefore, it's really important to get these stakeholders involved right at the beginning, even before you go to tender. And one other thing you need to look at is, will this technology be able to be integrated with other technology that the family office is using? Because if it isn't, and it's fantastic sitting by itself standalone, if it doesn't integrate with other technology, then that's a showstopper. And again, a lot of people have only found that out the hard way. So it's really important to ask the right questions when you start speaking to providers and vendors. So the bottom line is really technology must add value. And if it doesn't add value, then there's no point. So really, let's now concentrate on the data visualization tool and portfolio monitoring side of things. A lot of family offices are now, as I said earlier, going into direct investments, co-investments, illiquid asset classes. The issue about this, or the alternative asset class, traditionally has been the lack of transparency. Unlike public markets where everything is publicly available, private is exactly that. It's private, but you still need to get that transparency if you're having a varied and diversified portfolio. And one way of doing that is actually utilizing technology. So again, one of my warnings would be garbage in, garbage out. So if you're putting the wrong data into your technology platform, it's just going to spit out inaccurate or incorrect intelligence. So really what you need to start doing is finding out, getting the right data, getting the data from the right sources. And again, not all technology will be able to provide you that solution. So often people forget that actually it's the collation of the data which is very important. And then really it's the, what are you looking to capture? And I think any tool or any portfolio monitoring platform or solution needs to be able to report on the qualitative and quantitative data, because not everything is numbers, and it depends on why you're tracking that information and for what use. And really, if you've got a diversified portfolio, you don't just want to be able to track a part of it, you want to track the whole portfolio so that you have a single point of truth, which is a holistic overview, and then you'll be able to then want to drill down into the more granular level of information. So yeah, the end user must always be borne in mind, so that the worst thing would be to spend a lot of money, a lot of time, resources implementing a software or working with a third party provider, and then no one actually using it because it's too complicated or it's just not user friendly enough. You don't want it to be sitting on the shelf. And again, that's happened in a few occasions. So do family offices need to outsource or build their own solution? Well, I'm a little bit biased because I work for a third-party outsource provider where we provide an end-to-end solution. But obviously there's going to be pros and cons to which route the family office would take. And again, it really just goes down to the individual investor or family office. So, what's important to that investor? Is it, the expertise? Do they have the in-house expertise themselves to deliver this, or do they acknowledge that they'll need to hire additional staff, or would they prefer to just outsource that part of their operations? Focusing on core activities. Do you want your team to remain lean, or do you have wider or larger aspirations to go into something much bigger, and therefore you're actually very keen to hire additional staff with an array of skill sets? Then there's also the consideration on time and resources required. It will, I say this not to be negative, but these things always take longer than first expected. So are there any timelines that you need to hit, and if so, which route is best to allow you to hit those timelines? And again, if you're looking to get additional resources on, do you want them to be permanent or do you need them to be contract? So all of these things need to be taken into consideration. And then there's the mitigation of risk. Is it riskier to try and build something yourself, or try a plug and play approach, or actually by using a outsourced provider, does that offer or does that pose further risk? And a lot of the considerations when I speak to family offices are around privacy and considerations around those. For example, a lot of family offices I've spoken to don't like the idea of using cloud technology because on privacy grounds. But then, do people feel more comfortable by having all of their information on a server of a third party? And where do these servers reside? Do they reside in countries which are very different to where the family offices operate, in terms of different laws and regulations, etc. And I suppose that the last one is cost. How much are you willing to pay? What's the cheaper route, or what's the more scalable approach? So, for example, if you're looking to be a much wider or a bigger operation, does that vendor or provider's fee structure, does it cater for future use? So all of these things need to be sort of taken into consideration right at the beginning of the process. So there's lots of things there for people to take away in terms of things to consider. I will, in terms of outsourcing, I will now pass on to my colleague Bas.
Thanks, Hugh. I'll come back on camera after the next few slides to avoid the sound to be affected negatively. What I'd like to briefly expand on. Can you hear me, Hugh?
Yes, we can.
Okay, sorry. For a moment I was afraid I'll ask you guys. What I'd like to expand on a little bit, and thanks Hugh for setting the stage and elaborating on this. I'd like to briefly summarize why I think the next few years will be essential when it comes to putting in place the right asset structure and succession plan, if to the extent not yet implemented, and the importance of outsourcing certain key functions to subject matter experts. Personally, I like to do this against the backdrop of what's happening socioeconomically, simply because the bigger wheels in the back of our lives are going to have an effect sooner or later, and by that I mean the fiscal and monetary policies that are currently in place. They will eventually come back to have effect, and well, my personal opinion is that it could well be quite negative, but at the same time, we don't know what the future holds and how fast we might be able to find solutions and grow our way out of this. However, my concern is this: in history, we've never had a period where debt to GDP ratios were where they are now, including government, corporate, and consumer debt. The most reckless still being the governments, of late also corporate debt levels. The most prudent one right now, I think, is the consumer, because they feel the impact of COVID and are reducing debt levels on personal levels to the extent possible. But in a way, COVID is inducing an economic contraction, or at least a recession in the Western world, which governments can only respond to by adding more debt, and that's what's happening. And eventually, unless again we're able to grow and improve productivity, I can only see a poisonous mix of higher tax levels, potentially increasing inflation on the horizon, and in the case of Latin America, for example, further currency devaluation as a result of decreasing capital flows into the region, and again against the wider backdrop of monetary policies as they are being implemented. Meanwhile, the greatest shift in wealth from the baby boomers to the next generation is about to pick up steam, which makes a strong case for solid asset structuring and estate planning. Estate and succession taxes are the single biggest cost or bite out of any wealth in the process of transition. So it pays, and it makes a lot of sense to invest in a proper structure that holds up in the future and that will actually mitigate or reduce potential tax exposure to the maximum extent. Obviously, there are equally important non-financial considerations, non-tax considerations, such as family values, family governance, etc. But right now, in the transition, limiting or mitigating the tax exposure of a succession plan should take a prominent place. When we look at asset structuring in historic context, I would say, and this is probably known to most of you, in life there are two certainties, which is taxes and death. We pay taxes and then we die. That's how simple it is. And now, while we do talk about the former, we do talk about tax and as an essential element in considering asset structures and succession planning. We're less likely to talk about the afterlife, certainly with clients and especially with demanding clients when they are of high net worth and have have planned their whole life. They set the agenda, and it's not up to us to determine when that is a conversation to be had. And yet, I do think, as an industry, as advisors and professionals in this arena, it is our duty to put that item on the agenda and discuss the afterlife, because it applies to all of us. And like I said, taxes on estates and succession are the single biggest bite out of the sum total, and it really pays to properly plan for it. Now, that poses an additional challenge, the planning as such, and especially the sustainability and long-term effectiveness and compliance of it with an increasing level of international regulations that apply nowadays. These come from non-government bodies like EU, OECD, FATF, and they all have issued recently and are in the process of updating rules and regulations to keep in mind when structuring assets internationally and succession planning internationally. And misreporting or underreporting under those rules and regulations can have severe consequences, especially with, like you indicated, families increasingly having international asset allocations and stakeholders. Unless that expertise is available in-house, it pays to have an outsourcing partner to keep an eye on that. And I had a quick chat with our FATCA CRS reporting teams to see what are the most common mistakes or issues that they run into, and they range from classification errors, definition errors, or application for certain exemptions under either FATCA or CRS, and they typically lead to one of two consequences. One is over-reporting on personal information, which is something none of us wants on our clients. We obviously want to be compliant in what's reported, but not over-report, and we don't want to have to explain to clients what happens if we over-report. That's one major issue. The other is, in the case of under-reporting, the potential issue is penalties or fees, which is another issue we don't want to have to explain to our clients. So that is an area where I think it makes increasingly sense to have an expert, external expert in to keep an eye on that and to properly structure from the get-go. Now, a few trends and best practices that we've concluded based on the WealthX report, and also from what we see in our day-to-day practice. I think this is, I put a personal quote on there from Niall Ferguson, or I believe it's his, might also be Yuval Harari, who's a very productive writer on this subject. Eventually, humans we will be as much subject as the master of technological advancements, and will be both the source of data and the laboratory rabbit, subject to experiments at the same time. And eventually we'll come out much better as a society. We'll have a lot of technological improvements, and our life will be much better, provided we manage the whole project properly, and we do this as a society with eyes on what the values are that we've come to establish. And that's a big if. The future is not certain what that's concerned. What is for sure is that between now and then, there will be a universe of tremendous opportunities investment-wise, and quite a few challenges and pitfalls at the same time. Again, with families becoming more or continuing to be oriented internationally in their investments and their stakeholders, that is something that will increasingly be relevant, and a playing field that is increasingly difficult to keep an eye on, both on the challenges and the opportunities. At the same time, a trend will pick up that we think that sees, well, that as you indicated, is also confirmed in the report, that sees traditional real estate and index investments moving toward, well, losing some terrain to private equity, venture capital, and direct investments, simply because of the higher returns and the less risk-averse profiles of successors to family wealth. And then there's the ESG trend, of course, which is still to some extent a nice to have, a good to have, is the responsible investing and the ability to show the environmental, social, and governance compliance and impact with investments. Increasingly and quite soon, probably it will be a must-have in any financial report, as well as audit. So it will no longer be a nice to have, and managers that do not have it, will not be able, or are not able to report on it, will increasingly miss or lose investments and new clients. Now, in wrapping up and in summary, what I would conclude as, or a short list of main conclusions, and then I'll take the liberty here to summarize what has come over the past half hour. I think a mix of international opportunities and challenges is increasingly global, and so are families and their stakeholders. Access is easier, news is quicker, competition is more global, and that's an issue to be able to keep track of, to have on the radar, and to profit as much as possible of it. There will be shifts from traditional investments towards PE, venture capital, direct investments. ESG profiling and reporting is here to stay and will become mandatory very soon. There is an increasing need for subject matter expertise on non-core functions, simply because it avoids costly mistakes, and by that I mean the FATCA CRS reporting, the tax and regulatory reporting, and other financial reporting. And as a result of that, we see an increase in multifamily offices, which I'm sure you've noticed as well in your areas of expertise. The use of multifamily offices simply makes sense because of that ability to outsource to subject matter experts and to achieve scalability, continuity, sustainability, etc. One final note, which also came forward from the report: COVID will have an immediate effect, of course, to some extent, but it is unlikely to have lasting effect on the globalization of high net worth families and the opportunities. Bottom line, as Hugh mentioned, having IT-driven solutions in reporting, in regulatory and tax compliance pays, simply because of the ability to have access to the best of industry and state-of-art solutions. And that's it for me, Lindsay. I think let me switch the camera back on. I hope the connection has been stable throughout.
Yes, thank you, Hugh and Boz, for that. I appreciate it. To jump into Q&A, we again would encourage your questions, using your questions chat option to send over anything that we can go ahead and ask. Let's see, I kind of just want to jump right into it, to be honest. So first question, do you see any negative issues around technology?
Thanks. I'm just going to turn my camera off just to ensure we've got connectivity.
Thank you.
So, of course, there's always going to be some sort of negative issues around various factors like technology. I think cybercrime is a big thing nowadays, and that's because more and more of us utilize technology for more parts of our business and our private lives. So cybercrime is clearly naturally going to increase, and we have seen that. So obviously that's a very easy and sort of blatant sort of negativity when it comes to technology. I suppose the issue, as I said, I think I sort of explained a little bit in my presentation, was that unless unless you really devote and spend a lot of time sort of mapping out what you really want, what's your objectives, ensuring that everyone is on board and is sort of bought into introducing a technology of whatever kind, you know, there is a lot of time and it costs a lot of money, and it's you know, it's fairly it takes a lot of time. So there is that element, and I think it's not necessarily negative in itself, but people just do need to bear that in mind. Otherwise, I think people's expectations can suffer when reality hits. So I think people have to understand the limitations of technology as well. And in terms of the portfolio monitoring side of things, you know, a lot of that collation of data, or, you know, sick size review, you know, still has to be done, you know, through human interaction. So it's important to know that, you know, you might have the best technology available, but if you don't input the right information and it's not consistent, it's not mapped out correctly, then it's irrelevant, I suppose.
Great, and that was kind of to jump to my next question. Do you see any hurdles when it comes to the portfolio monitoring?
Yeah, I think that sort of follows on. It's the same sort of question. It follows on from you know, how you go about. I think mapping out. I think it's really important to map out, you know, as I said, your objectives, how you're going to achieve that, who's required, and then map out a realistic time frame. Because, as I said, these things always take longer than expected. So as long as you've got the adequate and relevant resources around that to make it happen, then you're fine. If not, it can be a struggle. So yeah, so I think that's probably goes hand in hand with my earlier answer.
Perfect, thank you. What is a typical time frame to successfully onboard a new portfolio?
So that's a really good question, actually. So I think for a typical, you know, single family office with a sort of you know, a portion of, you know, your traditional asset classes, some direct, you know, normally real estate investments, private equity, hedge fund type, you know, fixed income, you know, depending on what sort of data you're looking to populate and how long that portfolio has been going on for, especially on the private side, on private equity, with you know, listed securities, you can put a line in the sand to say when you want to start actually tracking these data points. But with private equity related, especially funds, you want to actually track back to the inception of that fund, and that could, depending on where you are in the life cycle of that fund, will depend on how long that take on will take, because you need to upload all of the historic data, and depending on how that historic data has been captured, will have a factor on the length of that take on. So normally, though, typically for a single family office with portfolio like that, I would say normally 1 to 3 months is probably a realistic time frame.
Perfect, thank you. Hugh and Boz, that does seem to be all the questions that have filtered through at the moment. Is there anything else that you guys would like to add before we sign off for the day?
No, not at all. I think that's it for me.
Yeah, same here. Thanks for having us, Lindsay. And if any question comes up later, then we'll communicate with you.
Great, thank you. Yes, and to all of our attendees, I will be following up with everyone individually. So if there are any further questions for Boz or Hugh, I will make sure to get you in direct contact. We thank you very much for joining us, and we hope you have a great day. Bye-bye.
Thanks.
Thanks, everyone. Cheers.
Thank you.
Cheers, Lindsay. Thanks, everyone.
Thank you.